Hi, welcome to Market Alert for Thursday, the 26th of March 2020. So the headline really is that the Senate approves historic $2 trillion stimulus deal amid growing coronavirus fears. And as thought and was proposed, as you read through this deal, the main part is here. And the reason I'm focusing on this is for one simple reason. It's not going to work. There's no way it's going to work. It won't be long before they'll be coming back for another 2 trillion within 6 months' time. But one thing that is very interesting in the article is here, where I've spoken before about helicopter money being provided by the Fed. And what we mean by helicopter money is direct payments to individuals. And you can see here that anybody that's earning $75,000 or less will receive $1,200 each, and married couples up to $2,400, well, with combined earnings. And then an additional $500 for children. And this is going to cost somewhere in the region of $300 billion, I think it is, which is staggering. And this is a one-off payment. So what's that going to cure? Absolutely nothing. And then there's no such thing as a free lunch, because as it states here, that it's all loans. Everything you'll read in here is about loans to business, not a bailout or anything like that. Bailouts are only for the large banks. So here you've got loans, and this is what you're seeing. It's not too dissimilar from the 80% of salaries in the UK, where you have to apply through the tax office, HMRC, and to get a grant. Which can take up to many months, no doubt, to actually process. So the whole thing is smoke and mirrors. The financial system is broken. This is what all of my other videos have been about up to this point, that we were on the downward spiral as far as the financial system. And now they're just printing and printing and printing. And they're going to continue to do this until they can do it no longer. Anybody who thinks that after the coronavirus disappears as quickly as it came are in cloud cuckoo. They really are. The devastation of closing the economic system down to this extent is unprecedented. It's never been done in the history of the world. And the knock-on effect, which is why they come out with crazy things like this, is to try and prevent it. They know full well it's not going to work. And the knock-on effect, as I've said weeks ago, Gerald Salenti said yesterday, and a few other interviews I've seen this morning as well. The commentators, everybody's saying the same. More people will actually die as a result of what's going on at the moment with regards to the economy than they will from the coronavirus. I'm not saying it's not real. I'm not saying that it's life-threatening. Of course it is. I accept all of that. But nobody's thinking about the impact of this after, which is going to be devastating. Housing market collapse, and also homelessness, which is already at its peak here in the UK, no doubt in the US as well. Loss of homes, loss of jobs, loss of income. The stress factor of that alone is going to be quite something else. So that's the dreary stuff out of the way, but it's important that you look at both sides of how these things work. But this 2 trillion, wow, that's a good one, that is. I mean, it was only 800 billion in 2008 to bail out the banks. Now we're looking at trillions in bailouts and loans and everything else, and it's not going to work, because if your business has already failed thanks to having the doors forcibly closed by the government, then you've got no chance. I don't know what it is with people who think that as soon as we come out of the lockdowns, we're all going to go out and spend, is beyond me, because most people will actually go the opposite, where they'll be very cautious because of what's happened. And it'll have the opposite effect, where you will have a full-blown depression, never mind recession. Anyway, let's move on and have a look at the market's reaction to this yesterday. We'll start off with the daily chart because you can see the day before put bulk of the move on 2,000 points, and then yesterday the market tried to move higher, and as I mentioned yesterday, the 20 bar moving average is going to be key. However, the market is not looking like it's going to achieve this, so a close back below the low will send the market to the downside, and I will be looking for the market to find some support around the 76% area there, 19,089. At the moment, the market's still managing to trade above the 21,000 level, but not for long, in my opinion. I think the dead cat is struggling to bounce here at the moment. So yesterday we see the follow through. We get the usual thing. We've seen this millions of times in the market alert, and if you're new to it, go back and have a look at the older ones. I think there's 500 or 600 in there where we've come through the whole of the last 10 years of this unfolding, where you'll see how it's been forecast in the market alert. So yeah, we get the usual move higher, move lower, right down to the close of the previous day. And once we get back above the 200 moving average, back above the 20, it's plain sailing to the upside. And the move back up here from this low to, I'll just click on that. We'll do from the top then down to the low is 1,480 points. This is a rigged market. There's no way that the stock valuations of the companies that are in the Dow perform like this at all. This is just pure manipulation by the Fed that we've seen for the last 10 years, and the plunge protection team bringing the markets back to make it look like everything's fine, even though it is far from fine at the moment. So the market moved higher and then stopped. We have a 76% retracement here, and then we see prices come back to it here as well, before then selling off and moving lower as profits are taken. Again, no surprise, another similar pattern that we're seeing evolving at the moment. So down before the close, 873 points off the 1,400 they put on earlier in the day. Incredibly volatile. I did jump in yesterday and had a bit of a dabble. I managed to grab 150 points, but then decided to call it quits. I mean, it is insane. Even in a 1 minute chart, you are seeing prices moving anywhere between 50 and 100 and 150 points in less than a minute. It's a wild ride, not for the faint-hearted, and more importantly, not recommended. The DAX I've looked at, that's doing more or less the same as well, but not so volatile. But it takes some trading at the moment. There's no doubts about that, because of the sort of distance that you have to have the stops, and also the amount at risk as well. So the implied volatility also kicked up yesterday, and implied volatility is the measurement of risk that the option sellers see in the market. This is still at the highs. I thought we've had a bit more of a reprieve, but I think they're looking for a bit of a move to the downside. The fact that this is increasing, they're increasing the premiums on both sides of the options at the moment as well. So yeah, keep an eye on this as well, because as I said before, we generally have a situation where we tend to breach the previous highs, or at least going back before, you'll see where this happens, where you get the double top or it's breached. So we haven't done that yet, so there is a lot to come as far as the downside. It is the weaker side of this market for sure. And the weekly charts show this as well. And what's interesting is the monthly chart. I love monthly charts, as you know. Love to see the bigger picture of where we are. Here's the 200 MA, and that's down at 1,500, another 5,000 points away. And I have no doubts that we will get there, as well as the stimulus package. Looks great. Absolutely one big joke. It's not going to work. It will never work. And you're going to see the markets head down and continue to move down in the monthly chart to the targets that we drew in a few weeks ago. It has no choice. The global economy has been destroyed and the financial system is broken. And the reason I know this and can say it with complete confidence is, if you've seen the market alerts for the last few weeks, even when they've pumped in or offered $500 billion on the overnight repo markets, the market has moved up 1,500 points, turned around, and then dropped 2,000. And that's what you're going to see more of. So let's see what today brings. And at the moment the market, let's have a look at the overnight, see what it's doing. Nearly forgot there. You can see prices are quite sideways there, range bound, which is makes a change actually. It's quite calm. The range there is only 364 points, which would be a good day on the Dow main session at 2:30, but overnight now you can still do hundreds of points. I mean, from that high down to here, it is literally unprecedented as far as the markets are concerned. 585, 600 points. These would be exceptional days. But now it's becoming the norm, and it has no bearing upon the underlying companies whatsoever. This is the Fed trying to keep the illusion alive that the stock market is fine and it's going to rally once more, as it did in 2008 onwards, but completely different now, for the reasons stated in the 3-part videos that I created. Okay, that's it for this one. As ever, thanks for watching. See you in the next one.